Good morning, traders. John Caruso coming to you here on August 11th with your currency outlook for the day. First, we'll take a peek back. Last week, non-farm payrolls, we did see a much stronger reading than expected. 209,000 payrolls added versus an expected 180,000. We also did see the unemployment rate decline 1 basis point to 4.3%. So some strong data on that front. This week, we have seen a series of inflation readings that have come in soft on a year-over-year basis. So inflation continues to be a problem here in the U.S. as well as in Europe. PPI slowed to 1.9% versus an expected 2.0% year-over-year, and CPI slowed from 1.7 versus an expected 1.8. That's one of the probably the primary reason why the dollar's having a hard time getting out of the woods right now. The U.S. dollar is trading down about 11% year to date, so it's been a rough go for the U.S. dollar year to date. Currently trading 93.26, down 14. I'm looking at the dollar from a standpoint of trying to play the trading range. The range that I've kind of mapped out is about 92.50 on the low side to about 95 on the high side. So you want to manage that trading range if you need to be trading the dollar here in the near term. So right now trading 93.26. We look at possibly becoming bullish from a near-term perspective if the market were to dip back towards 92.50. Inversely, looking at the euro, 118.50, trading up 26 right now. Largely the euro this week has been bouncing back and forth between 117.50 and 118.50. We have seen a global repricing in the currency markets. Perhaps it's because of the recent dovish rhetoric that we've seen out of the U.S. Federal Reserve. And actually, after this week's inflation readings, we have actually seen the prospects for a December rate hike here in the United States decline to 37%, which is the lowest we've seen it in quite some time. Actually, for 2017, it's the lowest we've ever seen it. So that's probably the main reason why the dollar's having trouble getting out of the woods. However, we are starting to see some of the growth data. I mean, we're seeing very strong earnings readings come in by the stock markets. I think right now aggregate earnings growth in the NASDAQ is up roughly 13% for Q2. So very strong data still coming in from the corporate side of things. Taking a look at Europe again, as I mentioned before, they're having problems with inflation over there. And they're also starting to see some of the economic data that's rolled in over the past 2-3 weeks start to slow as well. European Eurozone PMIs, manufacturing services, all slowed in the last reading, and we did see Eurozone retail sales slow in the previous reading as well. So they're having some issues over there. If you look at their stock market, the German stock market, the French stock market, both down approximately 7% since May. So we're seeing a correction in Europe from that regards. I'm going to switch gears here. We'll go to the yen and just kind of give you a quick technical reading on the yen. Right now, we're signaling immediate term overbought. Right now, the market's trading between 91.75 and 92. If we stretch to perhaps 92, I'd probably look at becoming bearish on the yen for a near-term trade. Forex traders, if you're following the U.S. dollar versus yen cross, we're currently trading about 109.14. So I'd go about 109 to 118.75 before you want to maybe become bullish on that cross. Just a quick reading on the chart there. So that's all I have for you. Once again, feel free to reach out to me anytime. I'll be around all day. And good luck. We'll talk to you next week.